Thanks for clicking! Canada's bond yields, and therefore its fixed mortgage rates, could remain high for the rest of the year, despite upcoming Bank of Canada rate cuts. This according to Ian Pollick of CIBC during an interview with Bloomberg.
Realistically be in a situation where by the end of the year, 10-year, 30-year bond yields look very similar then than they do today.
Yeah. So what?
Pollick is the head of fixed income, currency, and commodity strategy at CIBC, meaning bond market strategy, so he knows a bit about that which he is speaking. But the media did not make much of the comments, instead reveling in the return of the good old days where borrowers could borrow cheap, noting the end of the party for savers.
It stops today. You got it?
But given that we just got a great big fresh reminder that fixed mortgage rates are outside of the control of the Bank of Canada on Friday, I would like to have seen more, or any, media attention paid to Pollick's comments on yields, as the future is not quite as simple as Rob McClister's article that the punch bowl is coming back. So what I want to do today is go over Pollick's comments to Bloomberg, as someone should, discuss the underlying mechanics of the bond market to which Pollick is referring, and then discuss the return of the punch bowl. How big that punch bowl is will largely be dependent on Canada's inflation data, which is due out in a few weeks, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into this interview. On to the interview. As mentioned, CIBC's Ian Pollick told Bloomberg that bond yields, and therefore fixed mortgage rates, could remain where they are right now at the end of December, despite the Bank of Canada cutting rates.
Bank of Canada doesn't have a lot of domain on longer-term interest rates. Fiscal dominance is obviously the most important channel here. And so the growth of the bond market, which is growing 20% year over year, means that we could realistically be in a situation where by the end of the year, 10-year, 30-year bond yields look very similar then than they do today.
Wow, yeah. And given how much we've seen Bloomberg cover the extent to which rate cuts are going to send house prices upward, I'm sure this was shocking stuff. Definitely in need of a follow-up.
Then than they do today.
The Canadian dollar, it barely flinched yesterday.
I'm trying to ignore that.
Apparently. So let's take a brief look at that to which Pollick is referring. The difference between the Bank of Canada rate and fixed rates, what the Bank of Canada can control and what it can't. The Bank of Canada, in effect, controls three different interest rates: the overnight rate, the bank rate, and the deposit rate. The deposit rate is the interest rate the bank pays to financial institutions that hold their money at the Bank of Canada. The bank rate is the rate that those financial institutions would pay to the Bank of Canada if they had to borrow money directly. And the target rate is the rate that we generally speak of when we're discussing the Bank of Canada's interest rate. That's the rate that the banks, the financial institutions, pay to each other when they have to borrow money overnight. As we saw back in January when there is a shortage of cash on hand, or there is a shortage of good collateral on hand, and the banks try to charge each other an interest rate higher than the Bank of Canada's policy rate, the bank can and will step in to enforce its policy rate, lending the banks money at that target rate. Now, the central bank doesn't want to step in to lend the banks printed money, but it will if it needs to. And as such, the banks, in general, do lend each other money at the rate set by the Bank of Canada, with some obvious blips here and there. And that's it. That's all we're really talking about when we discuss the Bank of Canada lowering or raising interest rates. It's the bank dictating to the other banks how much they can charge each other interest, and stepping in when need be to enforce that policy. If the banks try to charge one another higher interest than that which was set by the Bank of Canada, Governor Macklem steps in and lends it for less.
I'll charge you 1.5.
That's the extent to which the Bank of Canada controls interest rates. And if you'll notice, it's not for very long terms, simply overnight. The Bank of Canada does not provide 5-year fixed rate mortgages.
Yet.
Fair enough. But right now at least, 5-year fixed mortgage rates are based off the bond market. Mainly, how much does the Government of Canada pay when it borrows money? And the bond market, as we got a fresh reminder on Friday, is not controlled by the Bank of Canada. As we saw on Friday when Canada's unemployment rate came in at 6.2%, we should have expected to see bond yields fall, as they have before, like they did on December 1st when Canada's unemployment rate ticked up from 5.7 to 5.8. Back then, in December, when the yield data was punch bowl-esque, the media remembered that we had a bond market, and mortgage rates fell. But that didn't happen on Friday. Canada's unemployment data came in higher, came in at 6.2, up from 6.1, and bond yields did this, ending Friday higher than they were right before the Bank of Canada cut rates. And the reason, as it almost always does, comes out of the United States, which we found out on Friday had much stronger job numbers and wage growth last month, sending U.S. yields higher. Many are now arguing that the Federal Reserve is going to have to wait even longer to cut interest rates, with some even saying that the jobs report takes even a September rate cut off of the table. So, U.S. yields are up, and as we've talked about so many times on this channel, when the biggest guy on the block, the U.S. government, pays more to borrow money, then the Canadian government is going to pay more to borrow money as well, meaning Canadian borrowers pay more too.
I got cash flow problems of my own. God.
Yet, despite these obvious mechanics at work, despite the obvious influence coming from the United States, we continue to see articles like this, with not a single word about fixed rates or about the bond market. Which brings us back to the punch bowl, and the party that the Bank of Canada is about to set off, with the markets expecting 200 basis points worth of rate cuts. 200 basis points worth of rate cuts while the U.S. economy is still running strong. Let's take a look at the last time that happened, back in the mid to late 1990s, when Canada's policy rate diverged from the Fed by about 200 basis points, sitting around 3.25. Back then, the yield on a 10-year Canadian government bond was just over 6%, very close to that of the United States, or about 3% higher than the policy rate, proving almost 30 years ago that just because the Bank of Canada cuts rates, it can cut all it wants lower than the Fed. That doesn't mean that bond yields, meaning fixed rates, go any lower.
Numbers were never my strong suit.
NerdWallet, the data on this is scant, puts the 5-year fixed posted mortgage rate back then at 7.35, 4 points higher than the policy rate, with even a 1-year back then sitting over 5%, about 2 points higher than the policy rate. So, fixed rates, both historically and currently, not necessarily coming down just because the Bank of Canada cuts rates. So again, back to the punch bowl. Are these advocates of the punch bowl saying that everyone should enjoy that punch and take out floating rate mortgages? Take out more floating rate debt?
You don't have a choice anymore.
Well, according to the article pushing variable rate mortgages, Canada could be about to see rising unemployment, sluggish GDP growth, continued painful mortgage renewals, and surging defaults.
We're having a party!
So, yeah, jump into that punch bowl, and if the economy worsens, the Bank of Canada is going to have to cut rates. Further, if you're lucky enough to keep your job, all of that new punch, all of that new debt that you took out, is going to become even cheaper.
He gets it.
So, both historically and current day, we can see just because the Bank of Canada cuts rates does not at all mean that fixed rates are going to go any lower. And this is what Ian Pollick was mentioning on Bloomberg. Yet, back to the punch bowl, we see in the media over and over and over again over the past few days that Canadians are about to open those wallets yet again. Now, I'm definitely not saying don't float. I'm not saying don't take a variable rate mortgage. What I am saying is that we're seeing article after article telling us that the party is back on, and none of these articles are incorporating the following. 1, it's not back on for fixed, not yet anyway. 2, those rate cuts are coming amid a weakening economy. If we don't get the weakening economy, we don't get the cuts, we don't get the party. And 3, does this sound like it makes sense? Canada has major mortgage renewal problems coming up. We have almost $3 trillion in household debt. Our household debt to GDP ratio is about where it was in the United States just before the world economy crashed. And now, on the flip of a switch, everyone gets to borrow cheaper, and the party just keeps on going.
That checks out.
So, in summary, Ian Pollick from CIBC making a great point on Bloomberg, that just because the central bank cuts rates doesn't mean anything changes in the bond market, and therefore doesn't mean anything changes with fixed mortgage rates. All of that is going to be dictated by the United States, and Bloomberg, predictable as ever, ignores it. Looking at the rates that the bank does control, we don't see anything in there that would allow it to control long-term rates, absent money printing vis-a-vis quantitative easing. In looking at history and the present day, we can see that, in fact, the bank does not control fixed rates. We can see with the underlying mechanics and what happened in the 90s, the Bank of Canada can cut rates and fixed rates will remain high. Yet, all we see in the media is that the punch bowl is back open, that the party is back on, and Canadians are going to continue to spend. If the argument is that Canadians can and should take on more floating rate debt as it's going to get cheaper and cheaper for them to borrow, then that's a fair argument, I suppose. But let's be very clear about the underlying economics that will be the reality if those cuts come to fruition. With that said, what happens with the bond market, as we saw today, is going to be almost entirely based on what happens in the United States, and we'll obviously continue to track those dynamics on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.